This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, now if you remember, we're looking at the various adjustments the accountant has to make when they're preparing the financial statements. And we've already dealt with two of them, accruals and prepayments, depreciation. In this chapter, and as always, I hope you've got the notes printed out in front of you. But in this chapter, we're looking at what we call irrecoverable debts and allowances. And again, although it looks a very short chapter, there are quite a few things I need to go through, so I will break it down into several shorter lectures. And this first one, let me really explain what we mean by irrecoverable debts and allowances. The point is, we'll have been selling goods on credit, and customers will owe us money. We've got receivables, and receivables, of course, appear in the statement of financial position. But the accountant will have to look at these because it could be that somebody owes us perhaps $500, and we discover that, I don't know, perhaps they've died with no money, and we're never going to receive that money. Well, we call that an irrecoverable debt. So an irrecoverable debt is where, for whatever reason, we're never going to receive the money. We will never receive payment. As I said, it could be because the customer's died with no money. It could have been a business that was owing us money, and the business could have gone bankrupt. And again, we know we're never going to get paid. It could, in fact, be a customer who's refusing to pay. We could take them to court, obviously, but there's an expense involved, and if they only owe a small amount, then we might decide it's just not worth taking them to court. We'll accept we'll never, ever get the money. But whatever the reason, irrecoverable is where we think we'll never, ever get the money. The other main bit of terminology is what we call a doubtful debt. And a doubtful debt, suppose I've sold goods to you and you owe me $100. But you've been owing it me for 3 months. You know, normally people perhaps pay within a month. I've kept writing to you, but you keep changing address and so on. And so I'm having problems getting the money from you. But I'm determined to keep trying. I'm hoping I'll get the money. But obviously, if you've been owing me for 3 months and letters keep getting returned, then there's clearly a risk that I won't get the money. So a doubtful debt is where we might not get the money. Might not get payment, but we're still hoping or still trying. So I hope I've made the distinction clear. If you're never going to get the money, we call it irrecoverable. If there's a risk that you might not get the money, but you still are trying, you still think you might get the money, then we call it doubtful. And in practice, it may be difficult to make that decision. You know, when do we give up trying? That's not your problem in the exam. In the exam, they'll make it clear. You've got various debts. They'll make it clear if any are irrecoverable or if they're doubtful. Having said that, though, let's look at how we deal with those. And to explain, look at example 1 on the second page and have a read with me. It says at the end of the first year of trading, there's a balance on the receivables account of Street of $62,500. So there's the total we're owed, and of course that total would be made up of several individual customers. And on investigation, this amount is found to include 2 debts from A plc and B plc, which are to be regarded as irrecoverable. The amounts owing, 2,500, 600 respectively. So A owes us 2,500, B owes us 1,600. They're included in the total, but we've decided we're never going to get that money. In addition, again included in that total, is 2,800 owing from Z, which is regarded as doubtful. So we're owed the money, we hope we'll get the money, but there's a risk we won't. There's one more line mentioning general allowance. Ignore that for the moment, I'll explain that when we come to it. And what we're required to do here, show extracts from the statement of financial position and statement of profit and loss of Street. So for this one, no debits and credits. I'll deal with them later, how we do the debiting and crediting. But as always in the exam, there's very little testing you on the debits, credits. More importantly, is what's asked for here. How will things appear in the statement of financial position? How will things appear in the statement of profit or loss? Well, first of all, let's think about the statement of financial position. Because, of course, receivables appear on the statement of financial position as a current asset. Receivables. And if all of that business about irrecoverable doubtful didn't exist, the receivables at the end of the year are 62,500, and that would appear on the statement of financial position. However, the first thing we say is, well, included in that are those two debts from A and B that are irrecoverable. We're never going to get the money. Well, if we're never going to get the money, it's ridiculous to show it, the total is still owing to us on the statement. We remove them completely. Now again, forget debits, credits, that comes later. But the receivables, this is just workings, they were 62,500. Included in there are these two debts we're never going to get, and we remove them. 2,500, 1,600. And so, if we remove them, that leaves us as being owed 62,500 minus 2,500 minus 1,600. It leaves us as being owed 58,400. So easy enough. Any irrecoverable debts, we forget they exist. We remove them completely. However, still included in the 58,400 is Z, who owes 2,800. And Z is doubtful. Now, I did say a few minutes ago that with a doubtful one, we're still hoping to get the money, so I am hoping we will receive the 58,400. But there is a risk that for whatever reason, we might not get 2,800 of it. Well, on the statement of financial position, we want to be safe. We only show what we think we're certain of getting. However, I don't want to remove that 2,800 completely, otherwise I might forget to even try and get the money. And so if a debt's doubtful, we do in a sense remove it, but we say, well, 58,400 is what we're hoping to get. 2,800 is at risk, so we show separately. We subtract what we call an allowance for receivables of 2,800. There's 2,800 included in the total, which we might not get. It's doubtful. And that leaves us with a final figure for receivables of 55,600. So that would be the final figure, subject to the fact there's one more line I've yet to deal with. That would be the final figure. But we do have to show this breakdown, that 58,400 is what we're hoping to get. That's the receivables less any that we know are irrecoverable. But we have to show the breakdown. 58,400 is what we're hoping to get. Separately, we're showing that of that 58,400, 2,800 is doubtful, is at risk, and 55,600 is what I think I'm certain to get. So that would be the final receivables figure. But again, that breakdown, that workings must appear. However, there is one more line. It says here, Street has a policy of maintaining a general allowance for receivables of 4%. Now, what this is, you see, Z, we knew Z was a problem. Z perhaps has been owing us for ages. We know there's a problem. Fine, you've seen what I've done. The rest of everybody, the remaining 55,600, maybe they were all invoices that were sent out recently. None of those have been owing for a long time, and so they all look okay to me. I don't see any problem in those. But maybe, looking at the past, on average, perhaps 4% of my customers end up not paying. In the past, always about 4% don't pay, but I've no idea who it's going to be. Again, all these remaining receivables there, they've all been owing just for 1 or 2 weeks. I can't see any particular problem, but I know that on average, 4% of them are never going to pay me. And so to be extra safe, I'll subtract an extra 4%. Again, we call it allowance for receivables. But this time, instead of it referring to, a specific debtor, Z, we knew was a problem, we've deducted, this is just a general 4%. Again, we don't know who it relates to, it's just to be safe. It's 4% of the amount we think is okay so far, 55,600. And so to be safe, we'll subtract another 2,224. Leaving us with a final figure of 50, hope my arithmetic's right, I think my battery's going, 53,376. So there is the final figure for receivables. We've subtracted those two allowances. The first one we call a specific allowance. Because that related to one specific person. That was Z PLC. We knew specifically that they were a problem. The other one, though, the 22224, didn't relate to any particular individual. Everybody else looks okay, but on average 4% don't pay. Well, we call that a general allowance. Now, as to why it's 4%, there's no rule here. It depends on the individual companies. Some companies don't have any general allowance at all because, everybody pays except one particular problem maybe. Other businesses, banks have a lot of people end up not paying. They might have a much bigger general allowance. Might be 5%, might be 10%. There's no rule. In practice, it's whatever seems reasonable. You tend to look at what's happened in the past. On average, 4% don't pay, 10% don't pay. It also depends on the economy. If the economy is going badly, perhaps you have a bigger percent. There's more chance of people not paying. Again, there's no rule. In the exam, you will be told the percentage. If there's no mention, then there's no general allowance. Otherwise, you'll be told it's 4%, it's 5%, whatever. Finally, though, in terms of presentation, although for this example, the final answer is 53,376. That's the final figure for receivables. The actual way it's presented on the statement, again, it's current assets. We will end up showing 53,376, but we do show the breakdown. We show what the receivables are after removing any irrecoverables. After removing the irrecoverables, it was 58,400. We subtract this allowance for receivables. However, although there are two separate allowances here, specific, I've said enough about why, the general, I hope I've said enough. On the actual statement, we don't show the two separately. We'll have had to do workings, but we just show the two together as one total. So 2,800 plus 222, was it 22224? Yeah, that's just my workings. On the statement itself, we only show the two together. 5024, and therefore again the final figure on the statement of financial position is 53,376. So there's the final figure for receivables. That breakdown must be shown somewhere. Small business will perhaps show it on the statement itself. Other businesses might show it, bigger ones might show it as a separate little note. But we have to show somewhere the 58,400 we're hoping to get, and this allowance of 5,024. Again, there'll need to be workings because they're two separate reasons, but that is just workings. All right, that's what it is in the statement of financial position. Finally, on the statement of profit or loss. Well, there is a cost of doing this, because remember, when I arrived as accountant, receivables were 62,500. And although I've said enough about why, we've ended up showing a much lower total of 53,376. And why? Because we removed some irrecoverables. It's costing us money to do that. And on top of that, we reduced by this allowance. Well, reducing the receivables is costing us. And so under the heading expenses, along with all our normal expenses, rent, electricity, telephone, wages, depreciation, and so on, we have this extra expense, irrecoverable and doubtful debts expense. And how much is it costing us this year? Well, again, the bit in brackets is my workings. The irrecoverable debts, it cost us 2,500 and 1,600 to remove them. In addition, we created these allowances, and we reduced by a further 5,024. And so the total cost of reducing the final receivables figure 2500 plus 1600 plus 5024. It comes to 9124. Now, in fact, in some businesses would show two separate expenses: irrecoverable debts expense, doubtful debts expense. You'll see later that becomes very messy. There's no need to. In exams, we don't. In exams, just one expense, the total cost of both the irrecoverable and the doubtful. But there we are. There's the presentation. That's the important bit for the exam. I've said in several places in earlier chapters, they will test you on debits, credits, but most of it is testing you on what appears in the statements. However, we need to do the debits, credits, and I need to take everything a little bit further to show you the whole picture. So we'll leave this lecture here. In the next lecture, we'll go through an example where we'll actually do the debits and the credits.